With less than a week to go, what will markets make of Rachel Reeves' budget? The UK budget is just 6 days away, and after weeks of preparing the ground for a rise in income tax across the board, it was reported at the end of last week that the Treasury has abandoned that plan. Bond prices fell and the pound slumped as markets expressed concern that the UK Finance Minister Rachel Reeves may not leave herself as much fiscal headroom as they were hoping for. Hetal Mehta is chief economist at St James's Place. Hetal, bond markets seemed rattled late last week. Are they looking for the government to raise more revenue?
I think they understand that there's a pretty fine line for the government to reduce borrowing, raise revenue, but also facilitate growth. And the immediate concern is that if the plans to increase income tax are being abandoned, then what else is there? It's one of the broadest taxes in terms of tax base. So to abandon that plan, if that is what the intention is, then does raise a lot of questions around what are the other levers that the government can pull. And so that's probably why we have seen gilt yields pick up. And there are a few other ideas kicking around, but maybe none of them would be quite as simple and as meaningful in terms of the size.
How much headroom against potential future shocks is the market looking for Reeves to find?
That's quite a difficult one to answer. I think we know that the last budget allowed a 9.9 billion headroom. That was actually the same headroom that the outgoing Conservative government had as well. We seem to be in a kind of perpetual state of having that slim headroom being questioned with the smallest growth wobbles, the smallest indication that interest rates would have to stay higher for longer. And so I think the market's looking for something north of that, but whether that is 15 billion or 20 billion is very difficult to know and to calibrate. But we would hope that some of the things driving the fiscal hole at the moment and what's prompting that scrabble for increased headroom would be one-off. So perhaps the OBR productivity downgrade is something that happens in this budget, but it's not repeated in subsequent budgets. So that bigger headroom and the lack of those one-off assumption changes should actually leave the fiscal public finances in a better state or more resilient to shocks.
Reeves does need to strike a balance, though, of course, between this fiscal restraint and also supporting growth. Are markets starting to worry about the lack of growth in the UK?
I think there are some concerns. The economy has been bumping along in a kind of muddle through rate of growth. It's not been so bad compared to the OBR's own forecast from the last update we had in March. But if interest rates are still staying a little bit higher, the Bank of England suggesting they may be ready to cut rates, but still higher than what the economy has been used to recently, then there are some question marks, particularly with the labour market turning. So the question really is about whether these tax changes hit in the near term or whether they are further out in the forecast horizon. And if they come a bit later on, then maybe that's something that gives the economy time to have to recover.
The pound is around its lowest levels, Hetal, since April 2023. What are currency markets telling us about the mood?
So when you look at the pound on a kind of trade-weighted basis, it's been range-bound for the last 2-3 years, so probably wouldn't infer too much about the latest weakness. But maybe the very recent change is, again, just questioning the growth outlook, but it's also, to some extent, a reflection of the Bank of England rhetoric as well, that given inflation has maybe not been quite as sticky as feared, they are moving a bit closer to a rate cut. It's probably partly a reflection of that as well.
Yes, the market now seems to see a rate cut in December as more or less odds on, but afterwards might it need to quickly go further in subsequent meetings?
So I think given where inflation is, and core inflation in particular, it's difficult for the Bank of England to signal a aggressive pace of rate cuts. It's going to be highly data dependent. We know the quality of some of the statistics around labour market, for example, are still a work in progress. And so it will be very much see how it goes with the data. And I think there might be some desire to have lower interest rates if the fiscal pain is front loaded, but assuming that some of that is more back loaded, then that is gives the Bank of England a bit of space to actually get inflation under control first.
That was Hetal Mehta of St James's Place. Don't forget you can watch more videos on Reuters.com.